Hi folks, I'm Joe Bongiovanni of the Kettle Pond Institute for Debt-Free Money, who along with my partner Pete Young have a website at economicstability.org. We're monetary reformers, and we do a Coffee with Joe session once a week at least, or we try to. And my partner Pete's out of the country, and that leaves me here today riding solo and trying to get a video posted. And I'm going to, what I want to do is I want to start out with the subject is full reserve banking. Okay? I'm going to start out with, I'm going to be reading a quote. This is from the Financial Times article from just a few days ago, in which Mervyn King, who's the head of the, I should say the governor, I guess, of the Bank of England, appearing before a parliamentary committee that's responsible for monetary policy in the UK, in which Mr. King has actually, to his credit, escalated the debate of what to do about reforming the money system. Not just the banking system, but the money system. He says in his testimony to the Congress, unless we look at the deep structural issues that have got us to where we are, we simply repeat the crisis again on an even bigger scale. And that little last part is the part to keep in mind. The next time it goes down, it's going down bigger. There's a political will for a discussion of radical solutions. It's taking things off the table that we need to avoid at this stage. That's what he said. It's taking things off the table that we need to avoid at this stage. So one of the things that we don't want to take off the table is full reserve banking. And that's my take. He was advocating at that point in the discussion that the committee bring in people like Dr. Laurence Kotlikoff from the University of Boston University, I guess it is, I should say, economist, who has been advocating one of the variations on the narrow banking theme. You know, recently our friend Dr. Ronnie Phillips penned an article in American Banker magazine in which he talked about maybe we need to go back and take a look at some of the old solutions, proposals for solutions, in order to make some progress. And there he was specifically talking about narrow banking and including full reserve banking. So so with that, we want to take a look at the doctor and what he calls it, by the way, limited purpose banking. Okay, and it's and he says the regulatory prescription is clear. Don't let banks take risky positions. Make banks stick to their two critical functions: mediating the payment system, you know, make sure there's money there when the check's clear, and connecting lenders to borrowers. Okay, yeah, lending real money. To safeguard the payment system, he says, banks must hold 100% reserves against their deposits. Either in cash or short-term U.S. treasuries for us. With 100% reserves, bank runs will be history. Now, there's the issue of bank runs, and there's the issue of the threat of bank runs. You know, the threat of bank failures. Bank runs are only people run and get their money out, but when they don't have their money because they're fractional reserve lending, you have a bank failure. It's really bank failures. That's the real problem, because then people have no place to go. And he goes on to say that we would not need the FDIC. This is a paper that he wrote for the Financial Times, in which he was positing his own narrow banking or limited purpose banking regime. Now, I'm doing this video as a response request to somebody who's been viewing our website and who asked that a commentary that said banks would go out of business because if you go to full reserve banking, we only have 10% reserves. Well, we're going to be 90% short on the money. Now, full reserve banking. I implore readers to find out what Dr. Irving Fisher renowned economists at the turn of the century into the turn of the century, last century. Excuse me, Dr. Frederick Soddy, the great writers on money at the time, had to say about it. It's the soundest basic principle with regard to banking and money, okay, that restores the permanent money system, okay. So now, the Chicago Plan for Monetary Reform, that came out in 1933 as a proposal to FDR, and it was included in there not only the government-issued debt-free money, which we advocate, also part one of the platform, but also full reserve banking. And the most renowned economists of the day supported it. Mostly progressive. It was mostly a progressive idea to bring it forward, as I presume Dr. Kotlikoff is, but also conservative economists and conservative thinkers supported it as well. I mean, I could just say that the sound banking, the sound money, I should say, there's a theory of sound money in conservative economics. All people that supported things that Dr. Milton Friedman, another conservative monetary economist who supported full reserve banking. So you have all these economists and all of these, progressives and conservatives, who supported full reserve banking. Could it possibly be that they are not aware of the need to maintain the proper level of the circulating medium? That's what the economists call it, okay, the money as we call it. That they could possibly not realize that, if we went to full reserve banking and we didn't replace the bank credit money with real money, that the government, basically, this would be a government reform, that the government has to replace it. No, of course not. Of course not. So to me, when I hear people talk like that, it's either propaganda, coming out from people who want to preserve fractional reserve banking for the benefit that it gives to the bankers rather than the people, okay? Because for every dollar that's created, and we need about a couple of $100 billion every year just to maintain price stability. For every dollar that's created, they get it. They get the chit on it. Instead of the public getting it, the bankers get it. But I have a problem with it because to me it represents a social injustice, because it is our money system. We own the money system, and we're not getting the benefit of it. Instead, the bankers are getting it. We could get the benefit of it by having money created debt-free by the government. So, again, bankers, I'll tell you what, the bankers will be different. When you go to the narrow banking or Dr. Kotlikoff's, proposals, under those proposals and even under the Volcker rule, which does not go far enough, I'm sorry, I have in the past called for Volcker taking Bernanke's place temporarily, but the Volcker rule doesn't go far enough. It wants to put in some separations and some limitations on what banks can do, but it doesn't go far enough. And whereas this proposal does, this proposal goes much further. But as far as it goes, it's going to shrink the banking community. Okay, when I say the banking community, the financial services, industry. It's an industry, folks. It's an industry. The debt industry of financial services. It's going to shrink that industry. It's going to first of all put walls up, and then it's going to cut tops off. And we're going to actually have banking go back to being banking again. That's what Dr. Kotlikoff said in that thing. Let the banks go back to doing what they're supposed to be doing, instead of creating the money. And when you allow them to create the money and you allow them to leverage it up, it allows them to create this incredible house of cards that needs to come down. And it can come down in an orderly way if we willing to take the bold steps. Gotta go. Phone's ringing. Thanks for listening. Pete?